Alright, very good. Some of you are new here. To do a quick explanation of how I look at the markets and how I see the markets, typically a little bit different than what most traders look at. I try to concentrate on price action, not on indicators. All these indicators you see here in your list here, right? Oscillators and DMIs and channels and moving averages and Keltners and all this stuff here. It's really based off a certain parameter, right? So, morning, Marcel. And so I try to look at it a little bit differently, not to pinpoint what we do as traders to a parameter, because anytime it comes to optimization and anytime it comes to something along the lines where you can look back in history and say this is the perfect parameter to use based on this 5-minute chart or 10-minute chart or daily chart, but moving forward into the future it becomes almost impossible to replicate that. So what I try to do as a trader is look at this a little bit differently and say, if we're going to take a long or short position, let's not base it off of any specific indicator that's linked to a parameter. Let's instead take a look at what price is doing, interpret what price is doing, understand, more importantly, why we're doing it, and then implement some rules around it. Are we going long for this reason? We're going short for this reason. So I have to look at trading in general not as one parameter that's going to fit the market or the time frame. I have to understand the market's going up here, the market's going down here, and then start taking what's happening, interpreting it, and then basing rules to trade long or short. Alright guys, very good. Alright, just do one more quick sound check here to make sure that everyone can hear me and that everyone can see my chart. One last sound check before I begin. I was saying a little while ago that I try to take a different interpretation on the markets. Alright, I don't want to link, and I was describing here all of these indicators that are available for Ninja, for TradeStation, whatever it may be. There's all these indicators here, but the problem with these indicators is that they're all linked to a parameter which you as a trader use, whether it be a 50-day moving average or whether it be a stochastic or whether it be an MACD, whatever it may be. All of these indicators are based off the same thing. They're based off of looking at price and then giving it a value and say, okay, if it crosses this moving average or if it does this, then you go long or short. So you can look back and optimize to a very specific value that will work into the past. But going to the future, it becomes very difficult to mimic those results. Okay, and the reason why is because markets are ever changing, right? Markets aren't the same every single day. Some days you're going to have slow days, some days you're going to have fast days. There's news, there's manipulation. These are all these things that, if you're unaware of, are going to skew those results. So instead, I try to take a different approach when I look at the market. I have to understand that the market is going down here at this point. I have to understand that the market is going up now. I have to base my decisions on what the candles are doing, and more importantly, I don't want to link a specific parameter tied to anything. So if you've seen the videos that I put out there, I try to show you a different way, not just put on a moving average and when they cross, go long or go short, or stochastics or MACDs. I try to interpret this a little bit differently. I want to understand first that because of news events and because we have slow periods and because we have more volatile times, that every day cannot be traded the same way. So it's important to first understand what the current conditions of the market is before you do anything. It impacts the way that you place stops. It impacts the way that you take profits. It impacts a lot of things. How long you hold a trade for. And therefore, when I look at the market, and we'll just take today for example, I can tell you that right now, if I went long, I can expect the market to move up or down about 1.5 points, 0.75. And that is the one thing that's constant. Because if you look at the current conditions tell you this is what it is. And moving forward into the immediate future, the next 4 or 5 bars, this is what I expect. But if that doesn't happen, that number will change, and I'm going to change my forecast accordingly. So this trade here, some of you that were here early enough to see it, is a double bar long for the Atlas line, telling me to go long at 14.67. It's right here, right? Now, the Atlas line is not linked to any parameter. Here it is, the Atlas line, right here. It doesn't have any parameter or moving average or anything that tells you that once this happens, you go long or short. I really want to use how price is acting and reacting, or what it's doing, to focus my trade on. So how does this work? Well, if you have some evidence that tells you that price is going up or price is going down, that's exactly what I'm after, the evidence. And therefore, the only reason why we have this 14.67 long entry is because 2 consecutive closes plotted above the Atlas line. That's it. The closing price of the second candle happens to be right there, 14.67. I'm sorry, this one here. 14.67 is right here, and that is the reason for the long entry. So you can see that I'm taking a different view on why I'm entering. I'm not entering because two lines crossed or above the 0 line or anything like that. I'm crossing it because price has proven to me what it wants to do and where it wants to go. From this point on, after I have a specific entry set up, now I can manage my trade. I can tell you what the exact profit is. I can tell you what the stops are. And again, I'm using price to dictate that. I'm not using anything else to tell me to get out of the trade or to get into a trade. I'm using price. So for example, at the time that this happened, 14.67, I looked straight down at this tool called the ATR, the average true range. If you haven't already taken a look at a few of the videos that I have out there explaining why I use this tool with a parameter of 4, I use the last 4 or 5 bars, tells me that the next 4 bars should be able to give me 1.5 points of movement. So I'm going to use that as my profit target, 1.5 points. So if I go long at 14.67, because we have 2 consecutive closings above the Atlas line here, I can tell you that 1.5 points is what I expect. We always have to have an expectation of what the market will do. Always. I can't expect 10 points. I can only expect 1.5 points out of this one trade. So 14.67, 14.68, 14.68.75, and one more for good luck is 14.69. This is where I have to have price lead me in order for me to take a profit. And if you look at what occurred, this entry at 14.67, this exit at 14.68.75 or 14.69 went exactly 1.5 points, 0.75, and it stopped. Now, I don't know if the market's going to continue higher, at least right now. And I don't know if it's going to reverse, at least right now. Actually, if anything, it is going to reverse. But the one thing I can tell you is that based on the current conditions at the time, my profit target of 1.5 was pretty much on track to get me in and get me out without wanting to wait for this thing to get to here, and then I wait and it never happens and I lose out on that trade. Anyone have any questions on having an expectation on where the market's going to go, using that as a profit target? At least start off with that. Marcel. So if you're under the Atlas line, you are only looking for longs. If you're above for shorts, no, that's incorrect. If I am above the Atlas line, I'm looking for long trades, right? To go long, right? Double bar long, we're above the Atlas line. If we're below the Atlas line, I'm looking for only short trades, the opposite, Marcel. Okay? Not that I'm only looking for long or only shorts, but if you're using the Atlas line, the trades that it provides are only long to go above and only short to go below. Okay? Alright, the other things that I talk about are news events. And hopefully everyone has seen the video on how I trade the news. I trade the news a little bit differently, like everyone else. Instead of bracketing off, I wait for the market to collapse and do the absolute opposite. Alright, so there's videos on that. But the one thing that I do want to bring to your attention is about news events, and specifically about afternoon news events. When you have afternoon news events like we did yesterday, specifically the FOMC at 2 o'clock or 2:15 Eastern Standard Time. Yesterday we actually had 3 afternoon news events at 12:30, at 2 o'clock, and at 2:15, at 2:30 I think it was. This is a little bit of a problem. Now you have to put yourself in the shoes of the rest of the world. The rest of the world will look at price or at these news events and say, okay, something's going to happen. Something's going to be said. This report's going to be released. So typically, the traders, they stay out of the market until the news event occurs. And when you have an afternoon news event, a 2 o'clock, 2:30, typically that's when the afternoon news events occurs, Eastern Standard Time, you have the entire day leading up to that report or that Bernanke speaking or whatever it may be in the afternoon. You have the entire day typically being whipsaw or range bound. So again, we have to think about the expectations. The expectation isn't that it's going to be a normal day. The expectation is that the market's going to flip-flop back and forth until that news event comes out, and then as soon as it comes out, it goes ballistic. So if you look at yesterday, okay, and I'll go over this pullback trade in just a moment, why this occurred and how and why this happens here for the Atlas line pullback trades. But if you look at yesterday, right? If you look at yesterday here, you can see the entire day was just range bound and whipsaw back and forth, right? The entire day. Until we have this 12:30 news event, and then it just took off. So how do we handle that? The way that I handle that is that I take a look at what has just happened as far as when the market opens here at 9:30. I look at what kind of range we're in. And I look back just a little bit and I say, well, here's a swing high and here's a typical low. So if anything, this is before the market opens, right? So if anything, I would expect the market to be stuck here until that news event. So I have an expectation of what the market is going to do before it opens. So if you know that this is a high, even if you look back here, this is a high that was put in place, you know that this is going to act as resistance and that this is going to act as support. So pretty much the entire day Just make sure I have this right here. Yep. Pretty much the entire day, as you see it, got stuck here. See if I can shrink this up here. Right. So pretty much the entire day was stuck based on this high and based on this low. So when the market opened at 9:30, this is exactly what it did. It didn't do anything else but that. So I always want to have an understanding of what is occurring. I can't think of the market as a machine. It's a living entity, and that's why I look at the ATR, the average true range, to tell me what's happening. Is it slow? Is it fast? Is it volatile? Is it dead? One of the things that I do is I place a median line where I say anything less than 1 point on the E-mini S&P, it's typically not worth trading. What do you get? Flip-flop, back and forth, whipsaw. So if you look at this entire area here, this is all, pretty much up to here, all under 1 point. And what do you have? Well, you have just green, red, dojis galore everywhere, indecision. So have a median for whatever market that you trade, whether it be the E-mini or the Euro or the Russell. Anything less than 4 to 5 ticks in, 4 ticks in the E-mini. In the currencies, I say 5 ticks. In other markets, it varies. I'd say, but typically if you use 4 ticks, anything less than 4 ticks is considered very slow. Stay out of trades that don't make sense trading or don't make sense risking. All right. David says here, when you have time, can you explain why I haven't rolled to December? No, I should be in December, Dave. Let's go to December here. No, I should be in December. There's a rule of thumb for those of you who, and it doesn't change. I mean, this is what I had here on the September, but it's the same exact thing. Here is the high, here is the low. This is what I expect to happen until the news event comes out. It didn't change, Dave. It's exactly the same thing. All right. Price is price. It doesn't change. All right. So let me just put the Atlas line back on here. All right. So today, in the December contract, we have 1, 2 consecutive closings, right? 1, 2 consecutive closings. 1462 is my long. What do? I look straight down and I say to myself, what is happening? Is the market slow? Is it fast? Where are we at with this? 0.9, I round down. 0.75, 1.75. This is my expectation, 1.75. I'm averaging down or rolling down to the nearest quarter point. So that means that 1462, 1463, 1464, I have to see price move to in order to get my 0.75 profit. And that's what happened. So whether you're trading the September contract or the December contract, same thing happened. Okay? You're welcome, Dave. Now there's a rule of thumb, a very simple rule of thumb. I have it on the blog. I also have it in the FAQ section of the DayTradeToWin website. If you ever want to have some questions answered, some resources there, I'm always updating it, so you can refer back to it. There's a rule of thumb to know when to roll over in the futures market. Specifically for the CME. For other markets like the oil, it's every month. It's a little bit different, but energies. But for the CME markets, you're going to have the expiring contract month, which is September, and you can always plan on rolling over to the next contract month on the second Thursday of the expiring contract month. So the second Thursday of the expiring contract month, you're going to have a rollover to the next month. All right, so it's very simple. In December, the second Thursday in December, you roll over to March. In March, the second Thursday. In March, you roll over to June, and so on and so on. So it's very simple. All right. All right. So let's understand what pullback trades and what strength trades are all about here on the Atlas line. You saw these S's here pop up, right? Usually these S's, these strength trades, are for 1 point. The pullback, I also prefer to have 1 point. The ATR is about 2 points. So let's be a little bit more conservative. Let's take just a point. That's what I recommend. Some of you have the Atlas line here in the room already, so you know the rules because we do a webinar, training webinar for everyone who gets the Atlas line. So you know the rules. But for those of you who don't know the rules, we're going long or going short based on a set of rules that are considered for pullbacks and a set of rules that are considered for strength trades. Okay? So let's talk first about a strength trade. What is a strength trade? Well, we have to put and give the strength trade a definition, right? Strength is the market pushing higher or lower with some amount of strength, right? So how do we identify that? Well, I identify that through price and through what the candles are showing me. So the strength trade has to start off with 2 consecutive candles showing me that they're green, higher closes than open. Doesn't necessarily have to be higher highs or higher closes or lower highs. I want to try to keep trading as simple as possible. So all I'm looking for is 2 green candles, which really I'm trying to identify 2 candles that are consecutively higher closed than open. All right. So 2 green bars. That shows me that there's strength in the market. But I need something else. What I need is a candle that breathes, a breathing bar, a candle that shows me that's taking a breath or a break before the strength in order to complete this. And therefore, I have here this red candle right here that's taking a breath, and then you have the strength that pushes up. And that is the reason for identifying this as a strength trade. And the entry is the close of the second candle. I'm going long based on strength, as for strength. All right. And then I can expect 1 point from that. Now you have to be careful, especially with strength trades, that the price has not moved so far with strength that it may now take a break like this. So if this had moved substantially higher, I would be more concerned that the market would be weaning or taking a break before it maybe comes down or maybe continues higher. That's one thing you have to be careful with. All right. Questions on that? So that's why the S's come up here. SSS for strength. It's a 3-bar pattern. I'm going long here for 1 point, 1467. Okay. All right, I'll take a look at that on crude oil, Alan. I'll take a look at that, Alan. You're welcome. Okay. The stops. I like to use stops that are dynamic. Okay. You've heard me talk about a time-based stop where I limit the amount of time a trade takes for it to produce me some produce where it needs to go. So I always have some type of time limit. I also have to look at a stop as very important because I don't want this market to go against me very strong. So I have to look at having more than one stop ideally being recognized. As soon as any of those stops occur, I'm out of the trade. So one of the stops that I use for the Atlas line is called a prove it stop. And a prove it stop is if I enter long here, I want to be out of the market with proof that it's not going in my direction. And so a prove it stop will be a close on the opposite side of the Atlas line. So if you're entering long here and there's a closing price here, that means that I shouldn't be there. Okay? Then we have a time-based stop, which is typically 4 to 5 bars. And then I have a stop that is considered a pivotal stop as well. There's also a catastrophic stop, but a pivotal stop is mainly used for strength and pullback trades. Since we're not going for a huge amount of profit on these strength and pullback trades, I have to incorporate a stop that's much tighter. It can't be a prove it stop all the way down here if I'm entering here, right? That doesn't make too much sense. So instead, I'm going to use what just occurred, this 3-bar pattern, as a pivot to help me manage this trade more efficiently. If this candle took a breath and then this candle gave me strength, that means that what just happened here is very important. This becomes a pivot, right? A type of pivot based off of these 3 bars. So the way that I like to look at a pivotal stop is I like to think about this as saying, if I'm entering here because, and only because, the strength pattern trade occurred, where there's a candle here going, breathing, and then 2 candles going higher, then if price comes back down and goes beyond this pivotal point, it's enough evidence, enough proof to tell me I should no longer hold on to this trade. I should be out of this trade because it's now breaking this pivotal point where it started to move up. Okay, so how I like to look at this is 2 ticks below this pivot here. That is my stop. 2 ticks below that. All right. Tim, let's take a look here. 1462, 1455. Yeah, I would say so. Absolutely. That's just too far away. Tim, I agree. So looking at the trades as they happen, we have to look at a dynamic way of thinking. Am I entering too far here, too far above the Atlas line, where the price may be now exhausted? Is my stop here, prove it stop, very far away? Is my pivotal stop here also too far away? So if we had, let's say this was all the way up here, and you enter here, you have to see if it's worth taking the trade if this stop is all the way down here. So all these things have to be understood, and you as a trader should be a little bit more, not robotic, but understanding of the dynamics of what's happening. Where are we entering? Where are the stops? These are the rules. Okay. You're welcome, Tim. All right, a pullback trade. Let me see if I give you guys a good definition of a pullback here. And I'll go to oil too. Alan, want to see oil? Pullback trade. Okay, so here we have a pullback trade here. So what is a pullback trade? Well, a pullback trade, I see here's the definition of a strength trade, right? A pullback trade is when you have 2 candles pulling back. We have to identify what is a pullback, right? So a pullback is 2 consecutive bars pulling back, and it could be more, it could be 3, 4, 5, 6. But the first candle that shows me that we are now continuing in the trend that we are following, right? Market's above the Atlas line, we're heading higher. The first candle that affirms that we're heading back up, that's the entry. So that's the reason for a pullback right there. The entry on these 3 candles here. close of that candle is the entry for a pullback. The same thing with this here. Here is two candles that are red pulling back. The first green candle, I'm going long. That's the entry right there. Here's another one right there. Questions, Dave. With the market being as choppy as it was up till yesterday, do you think it makes sense to extend the time-based stop a few more bars? I don't. Really, when you extend the time-based stop, Dave, it should be when the market is slower, or when we have a lower ATR where it takes longer for something to happen. But under these conditions where the ATR is, at least today, right now, we're closer to 2 points than we are closer to 1, I would stick with the time-based stop of just 4 to 5 bars. I wouldn't extend it out so much longer. The longer we hold a trade for, the more risk we're allowing ourselves to be in, because now we're just hoping that it's eventually going to go in our favor. So only when the market is just slow and very slow, I would say if you need to extend it just a little bit more on the time-based stop, but not when the market's working at a normal clip. It should get you what you want within the 4 to 5 bars, Dave. All right, let's go to crude oil. There's a question here about crude oil here. I think we are in the October contract. And remember, if you're using NinjaTrader, you're definitely looking at a news indicator that I have for free, available to everyone. And if you're looking at timing your computer clock, here, let me show you here. Timing your computer clock to the rest of the world. There are, let me go to here to software, go to here to free downloads. So there's a few things here. There's the news indicator for NinjaTrader. If you haven't downloaded already, it's a great way to know when news events are going to happen. If you're using TradeStation, obviously you can download a bar timer, which I don't know why TradeStation doesn't offer this already defaulted, but I found one for everyone to use who's using TradeStation. And this Karen time sync, I think everyone should have, because it really makes sure that your computer clock is synced to all the other servers in the world. So we're not off by a second or two, which definitely changes the closing price of candles. Okay. So these are 3 downloads that are available here. And if I find anything else that is important I think you guys should have, I'll add it to this list. Okay. All right, for crude oil, I think the market opens at 9 o'clock Eastern Standard, right, Alan? So 9 o'clock here. Right. Okay, so October crude oil long 99.6. 99.6 is correct, right? All right, so I think your question was, I don't see strength trades and pullback trades happening, or enough of them happening, Alan, in the crude oil. The first thing you want to make sure is that here you have this, the use the ATR set to false, because it filters out trades based on whatever you put here, either 1 point on the E-mini, or if you're using currencies, you want to filter out any trade that's slower than 4 ticks. I think it's 0.0004, right? So in order to avoid having any of these strength and pullback trades occur, you want to see them all, you would put here use the ATR to false, and it'll show all of the pullback and strength trades when they occur. So right now, what we have happening is this is a strength trade here. Okay, here. This is a strength trade right here, right, to go long. And now we have a potential pullback, right? So at the close of this candle, if it's green, you're going long. Would you agree with that, Alan? Right. Right. Now, if you remember, there's one additional aspect to this strength or pullback trades that we're using. Do you remember the filter that we use to make sure that this trend is good? Okay. In order for this pullback and these strength trades to be valid, sure, you need the pattern, but you need something else, right? You need to have some evidence that we are heading higher. We're heading higher. Because who's to say that after this pullback that the market hasn't changed direction, right? Could very well be now on its way down and change direction and go short, right? So what do we need? We need something that tells us, no, this trend up is healthy, or this direction that we're looking at is healthy, is going to the upside. That means that when and if this pullback trade turns green, it may be a few more bars, it may be this candle. If this candle here is green, like this, you will not have, Alan, a pullback trade to go long. It won't show. And the reason why it won't show is because it understands, the Atlas line, the software itself, it understands that you're entering here, and this is lower than either a previous pullback trade or your initial double bar long, which is 99.60. And when it realizes that we're not going up, or there's no evidence that we're continuing higher, it won't plot the pullback trades. It'll understand that this may be reversing to the downside. So this extra filter is installed, and the strength trades and pullback trades will not plot unless the entries are higher, always comparing them to the previous pullback entry for pullback trades. And for strength trades, it's always comparing it to the most recent strength trade. That means that any strength trade that you take here moving forward has to be higher than 99.83. So let me show you a few examples of that. Okay. Okay, so here we have a pullback trade, right? We have a pullback trade here because we have two green bars pulling up, and we have one red candle telling me it's time to go back down. Is this entry higher or lower than either a previous pullback or the initial or the original double bar short, which is here? It's lower. So if the only information that I have is price telling me that we've identified a pullback by these two consecutive green bars pulling back, and then or three, and then the first red bar that shows me, hey, we're ready to get back into the game, back down, I want to make sure that this entry is lower than a previous pullback entry or the original double bar short, which happened right here, to go short. Alan, you good with that? Anyone have any questions on that? Okay, no problem. Because the ATR value here is not listed in points. I think it's in cents or ticks here. So if you have this ATR value here, the E-mini, it works in points, but for currencies it's not points, it's ticks, or other markets it's ticks, not points. So you do have to make sure that you have this configured properly, or just turn it to false so you see all of the pullback and strength trades that may come your way, and just keep an eye on the ATR, know when it's too slow and when it's worth trading. All right. For example, you look at this here and you say to yourself, where do all of the dojis and all of the flip-flop occur? Well, it's all this, right? All of this is just red, green, red, green. I look down and I relate, where is this ATR? It's right here, right? So as a means test, take any trade, don't take any trade, I should say, that falls below this one here, 0.1 as a means to say I'm not going to get stuck in this back and forth whipsaw. And look, here it's the same situation. If you look straight down, it gives you the same situation. So if you know when you should be trading and when you not should be trading, you just have to make sure that you're using these right means tests for the market that you trade. And the Atlas line can trade any market, whether it be crude oil, because it's not linked to a parameter. Walter says here, John, these are great tips. Thanks. Factored into the Atlas line. They are, and that's why the most recent version of the Atlas line uses the ATR length of the last 4 candles, and now we're going to say don't take any trade less than 4 ticks or 3 ticks, so it's factored in, and you can turn it on or off. Walter, yes. No, I would keep it always, Alan, to 4 bars, the last 20 minutes on a 5-minute chart. I would always leave it to the last 4 candles, always. Okay. So here, if you're going to have a pullback trade, Alan, when it happens or if it happens, it will only plot if it's higher than the initial double bar long. It'll only give you that signal, because it wants to make sure that when you enter, it's entering with some type of confirmation that we're heading higher. All right? Questions, anyone on that? Yeah, the ATR value, I have to look at it, Alan. I would say definitely if the crude oil, let me take a look here, is this 0.1, I would say anything less than 0.1, which I believe was, I'm not sure if it's in points or in ticks, but I would say this 0.1. Anything above 0.1, you should be safe to go. Anything below 0.1, I wouldn't take a trade. Okay. Good question here. It was from David. David says here, what to do when, let me see Dave here. What do you recommend for the days when there is a reversal? It takes a long time for price to get on the other side of the Atlas line. I have a great situation for that. Because the Atlas line is placed at the US Open, actually let me go to E-mini here. And because the US Open is very important here at 9:30 Eastern Standard, or if you live in California at 6:30 Pacific Standard Time. But there are a few settings that we can set the Atlas line to start on, right? And actually let me change the bars back to 5. Okay. So when does the US Open start? At 9:30 for me, 8:30 if you're in Central. If you're in Australia, it's probably 23:30. But the E-mini US Open or the financial US Open for me is at 9:30. And so I can expect some action to happen. So that can be a plot number 1. When else can we plot it? Well, the London Open. The London Open for me is at 3 a.m., which I'm sleeping, EST. It's locally at 8 o'clock, 8 a.m. locally. 8 a.m. local time in London, right? So if you want to look at currencies, or if you want to look at other markets, you would change the Atlas line to instead plot, or add a second Atlas line to instead plot at the London Open, right? To catch Forex currencies or future currencies or FTSE, or whatever the case may be. So what do we have? We have here a London Open with the same rules, nothing changes, it's exactly the same. Okay, now the question you had was, what about when it reverses, let's say all the way here, and then it starts to come back down? We're never going to get a trade, right? Because higher entries, right, have to be made in order for pullback and strength trades to occur. And not only that, but if I want to go short, I have to make it happen when we see two consecutive closings below the Atlas line. Alright, so here is how we do that. There are two other plots that I recommend, and I think I always go over this in the training, David, as well. They are auxiliary, which are 12 o'clock Eastern Standard, which is the first 2.5 hours after any trading period, U.S. session or London session, and the 1400 EST, which is for late day rallies and late day sell-offs. So if you have a situation where the market's made its move all the way up, and now you're looking for another Atlas line plot, maybe it looks like this, maybe it looks like that, I don't know what it looks like, but you would change, or you would add another Atlas line here to your chart for 12 o'clock Eastern Standard. So let me show you a day where that occurred, and you can identify that. So let's go to this here for an example. So here's an example. This is the 12th, a few days ago. So here's the 930 Atlas line plot, right, to go short. And now the market's starting to head higher. There's really no other chance for another trade to go short unless we start going lower. Here is the 12 o'clock EST Atlas line plot that I added, and now you take trades not based on the 930, but you take trades now based on the 12 o'clock Eastern Standard. The rules are all the same. The long and the shorts are, just reset this here, the longs and the shorts will be right here, right? Double bar long, double bar short when it comes below, here and here, double bar long, here and there. That's the 12 o'clock. Now if you wanted to add the last but not least 1400, it's not something that I want to add all the time, but you can. Another Atlas line plot, 1400. And now you can take trades based on double bar short or double bar long. So as the day moves ahead, there's really only three that you should be using during the U.S. Open. Well, it doesn't really matter if it's U.S. Open or London Open, but the main, which I always have, is the 930 EST because that's the U.S. Open for me. 2.5 hours later, followed by the late day rally, late day sell-off. Remember to adjust these times for you in your time zone. Right? Remember to adjust the times for you in your time zone. So these are really auxiliary. If there is no other trade to be taken because the market is moving not against the Atlas line where there's no other trades that are there, that's when you can add these. All right. Dave, you good with that? No, I don't. You're welcome, Dave. No, I don't, Walter. Right, so my recommendation, because I don't like to have my chart cluttered, is I'm not going to add this and this right away. This is the Atlas line for September 12th. And as soon as we start heading higher, I know that I'm never going to get a long here. I know that it has to move beyond that and go lower. So you can either add another Atlas line, you can just change the current one to plot or make its calculation for noon. And so this is the noon Atlas line. And you can take these double bar long trades or short trades here off the noon Atlas line plot, and if need be, you can then add the 1400 if you need be, and you just change it to that. Okay. Um, okay, for scalping, it depends on what you want. Okay, because the two scalping courses that I offer, one is a counter trend, and the other goes with the trend. The one that goes with the trend is called the Trade Scalper, and you're always looking at going long or short as the market goes up or as the market goes down. So that's going with the trend on a 1-minute chart. The other scalping method that I offer is called the price action scalping method, which again, all of this has no indicators. It's just price, and it's a counter trend method using a tick chart. I use a 250 tick chart to go against the current trend. Both courses, they're completely different, right? The price action scalping uses levels and uses a tick chart. They both go for typically about 3 ticks each trade. So it depends on what you're after. The price action scalping tick chart method is only for the E-mini S&P. The trade scalper is on any market. On any market, using a 1-minute chart, you're always going with the initial move or the initial trend, and everything is rule-based as well. All right. Tim, I don't monitor the cash S&P. I think that the more things you look at while you're trading, personally, I think it just makes it more confusing. So I don't look at other markets or cash or 60-minute, 30-minute. A lot of traders like to look at 60-minute, 30-minute, 12-minute. I don't do any of that. I look at just one chart, typically the 5-minute chart, and I go up or down from there. You got it, Dave. All right, very good. I have a student coming up here at 11 o'clock. And so I just wanted to, as I close this out, just wanted to make everyone aware of the next mentorship class starting in about a week or two, September 24th. If you're interested, you can join up for the next class. Email me if you have any questions on that. All the information is on the website as well. We go 8 weeks, and everything is included. All the methods, all the courses, all the software is all included. And I'll see if I can put this recording online in the blog later today. So if you want to look back and you want to check this out, you can. And if anyone has any questions, let me know now. If not, I'll see if I can have another one of these webinars next week or in 2 weeks. Usually I try to do them a few times a month. And hopefully you got to learn something and see a little bit about how we look at trading. Great, Michael. All right, very good. Absolutely, Gary. There is still room for the mentorship class starting on September 24th, I think it is. So you can sign up online, or you can email me if you have any questions. All right, very good, Gary. You got it, Juan. Michelle, Michael. Take care. Have a great weekend. Bye-bye now. All right, Bob, you got it.